Forbes India cover story podcast series in association with theindicast.com. One of the highlights of this package, in addition to the cover on Xiaomi, is a feature on KKR, the private equity behemoth. These are not quite celebratory times for an industry that has been hit hard for many, many reasons, including the overall sluggish growth and the stress in the non-banking financial sector. Pooja Sarkar, the author of the story, is with me on the other line. Hi, Pooja. Nice to have you back.
Thank you so much, Abhishek. Thank you for having me back.
Thanks. Very quickly, if you could give us a glimpse of how is the overall private equity sector in India doing? Who are the players and how is the overall situation as of now?
So, if we start with private equity funds in India, it has been for the last 2 years. If you see, India has seen the highest amount of capital come in through private equity funds in India. Last year, in fact, $10.8 billion came in, and which was the second highest according to the Bain Capital numbers. So, basically, if you see private equity transactions are at a high in India right now, we are seeing a lot of majority control transactions happening, basically, where private equity funds are going ahead and buying out companies and then investing in them and taking over those companies. Earlier, if you see over the last decade, companies would try to sell a small portion of their stake to private equity firms. But now, if you see, majority transactions are happening, and transactions larger than $100 million has become the significant portion of the transaction size in India. And some of the biggest guys that are deploying capital in India, the big names from the US, for example, are KKR, Blackstone, General Atlantic, then there's TPG. Some of the big guys are deploying capital in the PE space in India.
Yet, the story takes a critical view of the current times that the sector is going through, where KKR, as such, and to quote you from the piece, you say that lessons for KKR from lending transactions that have gone sour have hit new lows. So things are getting bad to worse. Why is that?
So coming to KKR India specifically, if the story that it talks about, you have to remember that KKR India was one of the first global private equity funds that came to India and started doing debt transactions. As you would know, private equity means equity transactions, but these guys started the culture of doing debt transactions, and they would lend out to developers, they would lend out to your promoters who needed finance and or to the companies. So KKR India specifically has two lending books in India. One is the real estate lending book. Specifically, it is called as KKR India Asset Finance. And the second book is the wholesale lending finance book, which is the KKR India Financial Services. And this story takes a look at the book of KKR India Financial Services, where the fund had gone ahead and lent to promoters and to companies cross sectors in this vertical.
You also allude to a certain corporate governance failure. So what is that about? How does that cue into the whole story?
So if you see, they had one investment which is called as Quality Dairy. Now, Quality Dairy was touted as one of the largest dairy companies, listed dairy companies in India, based out of Delhi. But last year, KKR India took them to NCLT. When you take a company to NCLT, you basically start the bankruptcy proceedings against them. So basically, they are saying that Quality Dairy at this last annual report that they had, that was in FY18, the number stated that they owed nearly 195 crore to KKR India. But KKR took them to NCLT, and that amount has been written off completely from the book. In the case of Coffee Day, that is your CCD enterprise, if you see there, the promoter passed away some time back and he had committed suicide, and he had said that there's some discrepancies in the numbers of the company. So if you see, that is one example. And then there is another one, the recent one that has come into fore is the CG Power and Industrial Solutions, which is earlier the Avanta Group holding company, where KKR India has now come in. They have invoked their pledges. They have bought some from the market. And that's why these are the companies where, if you see, there are some distinctive problem with the kind of reporting that has happened with regards to numbers. And so if a company is reporting wrong numbers, and if the debt numbers are stated as wrong, then obviously there is something wrong when it comes to corporate governance in the company. So right now, KKR India finds itself in a spot more so because, there are these companies where it is not just that the company is not doing well. It is not a problem of the company not able to do sales, or the company not able to recover capital from its buyers or its vendors. The problem here is misreporting, which comes under corporate governance issues.
So, what did you find out when you spoke with KKR India CEO Sanjay Nair? What is it that they could have done right?
So when we had a conversation with Sanjay Nair and his team, what we understand is that they see that there is a problem and there is some stress in the book, but they are saying that they are looking to recover capital from some of these existing transactions. They are trying hard to either be a significant shareholder in the company or acquire majority debt, not shareholder, that would be a wrong word to say, but acquire majority debt so that they can control the debt stack. In fact, going forward, that is what KKR India is planning to do in some of its transactions, where they want to be the largest debt holder in the company and work with the existing banks, because banks finance your regular working capital. So they want to work alongside banks, intercreditors, so that they hold significant amount of debt in the company. I mean, they would rather do less transactions in terms of numbers, but they would do a high value transaction so that they hold a significant debt in the company, because even if the company has to go under a bankruptcy process, then they have some say when it comes to recovering of that capital, recovering that debt.
So, is their business model any different or at odds as compared to those of their competitors?
No, so this book, so they KKR India has a private equity book. They have also invested in infrastructure, but they have these two NBFC books, and NBFC is one of their largest books in India, and are they really believe there is a lot of value in this ecosystem. And if you see, India's debt market is not a pretty much a deepened market. Our bond market is not deepened. Our debt markets are not very deep in that sense. For example, globally, it is very easy to sell my if I buy a if I give a loan to a company, I can go it and piecemeal and sell to other peers. But in India, those opportunities are very less. There's not very active. That's not a very active secondary market for loan selling. In that sense, KKR really would like to deepen the market presence when it comes to debt lending, and they believe that there is a huge opportunity in this segment. It's just that the markets are bad and the timings are bad, and everything is throwing up right now because we are seeing so much of stress in the ecosystem generally. And that's why they believe that going forward, they are also looking to engage with other parties, for example, for consulting, for auditing, or for doing forensic research on a company that they're lending towards. So if it's a transaction over a $15 million, they will be very careful in undertaking far higher due diligence than they used to do before.
And just to put a perspective, can you share some numbers? What is the extent of the damage that we are talking about here for the transactions that have gone sour?
Wholesale lending book is a 6,200 crore book at the end of March 2019, which is the publicly reported number. According to our numbers, if we see, for nearly 475 crore is the exposure just between your CCD and CG Power. They have written down 195 crores of Quality Dairy, and there are some few more transactions like Resonance, and then there is Syntax BAPL, where they had a large exposure. There are these exposures where they're trying to work, but I don't think they're being considered as NPA yet on their books.
And yet the situation, you're right, isn't bad enough, is what Sanjay Nair reckons to ring the alarm bells. So what is the plan in the near future?
So going forward, they're really looking to change the way it does debt transactions in India. So basically, as I said, they would like to be a significant lender in a firm. When you're a significant lender, then it gives you an opportunity, because if you go to a bankruptcy process, then you'll be able to have some say when the process is going on, or be able to recover some capital. You could be the first person who would be able to recover capital in the entire hierarchy of the process, and that becomes very important in these times, because there is very little visibility on a lot of these private equity firms who have lent capital and have gone to bankruptcy process.
Right, and finally, hopefully, it is cyclical, is what the experts are saying. The current economy slowdown. What happens if the economy itself takes its time to pick up? Where does that leave players like KKR?
It's a very interesting question, because if you see, the government is trying very hard to infuse capital in the entire ecosystem to keep things moving at a better pace than what we have been seeing over the last 8 or 9 months. Our economy is slowing down if you see our GDP numbers also. But the point is, when it comes to a market when there is significant crunch in capital, people like KKR India, they have huge amount of capital on their book. these are some most of the capital is balance sheet capital. They have large LP investors, global investors who are now seeing it as an opportunity to come in because you'll be able to find better transactions at this point in time, and you'll be able to clock better deals. You can lock in with people with a significant amount of premium in terms of returns and guarantees when it comes to getting your capital back. But this is where a lot of global funds are seeing an opportunity if they have capital on their books to come and deploy and get better transaction. Because even when it comes to equity transactions, also if you see valuations in the private markets have also come down, not as much as public markets, but valuations have come down, and you can strike a better deal because promoters want capital. Capital is the need of the hour.
Interesting times. You might want to do a follow up to find out in due course as to where this pans out. Thank you very much, Pooja, for your time on this podcast.
Thank you so much, Abhishek. Great speaking to you.
Thanks. And all you listeners, you can get this podcast on ForbesIndia.com as well as on iTunes. And to have someone call you for a Forbes India subscription, message Forbes to 51818.